Well, Barclays has developed the Barclays Wealth Financial and Personality Assessment. Both of you have been very involved in developing this and ascertaining it. But I suppose before we get into that, let's just take a look at the traditional approach to ascertaining risk and the risk profile of clients. Quickly.
Yeah, I mean, I think if you go back a decade in this industry, a lot of insurance companies would ask you to kind of ascertain how you feel about risk. And they would ask you questions such as, do you like bungee jumping, or do you ride a motorcycle over the weekend? And then you would get a kind of a tolerance as far as your risk is concerned. And hence, people would then invest money relative to how you felt about risk. And just to kind of give you a visual on how this actually looks, just look at the graphic on your screen there. That's literally how some of that actually worked, actually quite simplistic. You know, what is your risk tolerance? Is it high, or it could potentially be low? If you want to be low, well, invest in money market funds.
So where does fly fishing fit into this, or stamp collecting?
Stamp collecting, I suppose, is maybe off the charts on the low side.
What happens if you're both a stamp collector and someone who likes bungee jumping? Makes it a little bit complicated.
Well, maybe that's a question that you should be asking Phil. I mean, it's what happens when you've got an investor with kind of two sides to that equation?
I think that's exactly the problem, is that your traditional way of risk profiling clients is very simplistic. It's typically been designed by people who are actually advising clients themselves. They haven't been scientifically designed, they haven't been tested, and they typically result in most clients ending up in a moderate risk profile. They make the assumption that your risk profile is the only determinant of how you're actually going to invest. And actually the regulator prescribes that when you do give financial advice, that you do have to take a client through a risk profile. So what you need to do, though, when you are looking at a client, and it's important to understand that as investors, we all make behavioral errors. We've all got unique components of our personalities that result in us making errors from an investment perspective. So what we've looked to do is try and define those different categories that will help us help our clients be better investors, and sometimes help us understand our clients a lot better as well. And that's a very important part of it. So you need to look at more than just traditional risk tolerance. Your risk tolerance, believe it or not, is actually part of your personality and is something that is stable throughout time. It's not actually affected by day-to-day goings-on in the markets. It's not affected by what's happening in Europe or in the US.
Not affected how much money you have in the bank. Because of course, you know, you kind of start out the month with the salary in the bank and you're feeling like you can go out and spend money, you're feeling wealthy, and then at the end of the month you're feeling a little bit less wealthy, and you know, risk profile decreases that.
You'd be surprised, because the answer to that is actually no. And again, the traditional way of risk profiling clients globally, and bearing in mind most people still do it the same way, is they ask, what kind of risk do you want to take? Do you like bungee jumping? Then how long do you want to invest for? And then how much money do you have? And then they decide how much risk you're going to take. Now, very often when someone is extremely wealthy, they can be even more risk averse. You need to take into account different components of their personality. So I often give the example of a Bill Gates versus a Richard Branson. Now, those are two very different people. They've both got a hell of a lot of wealth, but the way you're going to invest for them is you would invest in extremely different ways. Richard Branson, being an entrepreneur, is likely to have a low level of composure. He's likely to react a lot more to what's going on in the markets, where Bill Gates is likely to have a much higher level of composure. Now, that is a guess, of course. Luckily, we took Roland through a similar kind of example, but I've seen it with work colleagues of mine, with clients of mine, where how you would often assume that they would behave in a certain way. But you can't actually work that out until we hit into a euro crisis or a banking crisis. You need to understand before you invest for a client how they are likely to behave in those circumstances.
I mean, Barclays developed a system that Phil is talking about, and maybe we should just show the viewers what the system actually looks like before we actually start taking Roland in, because they've actually done this exercise on Roland. So before we actually go through that, let's just show them the dynamics of this. Just look at the again at the graph there on your screen, or shall I rather say the visual, and you can see there's a behavioral approach here to kind of understanding your financial personality. It goes through what we call a risk attitude assessment and a decision style assessment. The first one obviously has to do with risk tolerance, and that obviously asks the question, how do you tolerate risk? Composure obviously deals with how do you respond to changes. Market engagement, how engaged are you with the market at the end of the day? Is it high or is it low? And then there's a whole bunch of things here on decision style, things such as perceived financial expertise, desire for delegation, and belief and skill. And somehow I believe that if I think about Roland, he doesn't believe that skill actually exists in the asset management industry, but we're going to have a look at those results just now. I mean, you guys use this system. How long did take us through the development here? How did Barclays actually come up with this thing?
Well, we've got a team of 4 in our behavioral finance team. They've all got PhDs in behavioral finance, but they've all focused on how to use that to assist people to invest. So what they did is they looked at broadly across all the academic literature available. They then surveyed a number of clients and bankers. They narrowed it down to about 450 different questions that they would likely to ask. Took this through a significant survey of about 4,000 test subjects. That was then tested and narrowed down to 36 major questions. That has then been taken through clients, in total about 10,000 subjects now that have been through this, and a lot of them pre and post the financial crisis. So what we've ended up with here is a very stable set of questions that are consistent for clients pre and post crisis, which is one of the most important things. But importantly as well, these questions need to guide us as to how people make the financial decisions. If we sit down and put together questions between us as a panel, we're unlikely to ask scientific questions. They're also got to be strung together in a way that leads us down a meaningful path that assists us to manage a portfolio.
Walk us through some of the typical questions. If you had to walk through each of these sections, you know, in terms of assessing risk, just tell us about some of these questions.
Well, I think if any of you have been through any kind of a psychometric test before, the questions are quite subtle. So you wouldn't necessarily be able to second guess the questions. In fact, they're designed for you not to be able to second guess them. And in isolation, they might seem like quite simple questions, but actually as a combination, they give us a meaningful picture. So if we look at some of the dimensions like composure you mentioned, market engagement, low market engagement is actually for someone who doesn't really trust financial markets. Now, very often in the private client space, you've got people who don't invest. They simply have made a lot of money, but they sit in cash. You spoke a moment ago about money market funds. There's a lot of money that sits in money market funds, not because it's the most efficient place to invest, but because people just don't trust financial markets. So something like a low market engagement will give us a strong idea of how to invest for that client, whether we've got to put together some level of protection in the client's portfolio, whether just some sort of a guaranteed type investment product in general. Composure is the other very interesting one, because you can have a very high risk tolerance and very low composure. Now, how do you deal with a client?
So you aren't able to deal with the kind of crisis when it
you
comes,
want to take
even though
risk,
you think that
you want to take
risk,
but you can't take it.
Yeah.
And you've got to then bring in some sort of a smooth type return into a portfolio. You would be very cautious of putting that sort of a client into an illiquid product or an illiquid investment, let's say like private equity, that when things do get tough in the markets that you can't get out, because those are the typical clients that pull out at the wrong time. And what we find that we know it's very tough in the financial world, in the investment world, for anyone to beat the market. We can debate that for a long time as to whether anyone actually can. What we do know for sure, though, is that private investors, or even professional investors in their personal capacity, by the way, who also make significant behavioral errors, tend to further destroy returns in their portfolios. So what we're trying to do with this here is, first of all, take something that's traditionally been academic, make it relevant in terms of building a portfolio that a client is going to be able to stick with through the good times and the bad times. And then at the end of the day, what we've got is we've got a happy client, and we've got a better chance of you showing better risk-adjusted returns without pulling out at the wrong time of the market.
And you know what? All this stuff is very academic, but what I really want to do is I want to look at Roland's profile.
Because he seems
actually
like
the
calm,
proof's in the
cool,
pudding.
collected type of guy.
Absolutely, and
Is
he's
that the
German,
truth?
and he's German, as you know, and he's a quant.
I'm flattered that I'm in the same league as Richard Branson and Bill Gates, but let's see.
Well, let's have a look at Roland's profile, and there you can see it on screen. And maybe I'm not going to be talking through that. I want Phil Bradford to be talking through that, because I think he's going to be adding a lot more value to Roland's profile.
First and foremost, Roland is a moderate risk type investor. So that is something that's often difficult to tell about someone just on face value. And very often, people are generally very poor judges of their own risk tolerance. That is something we know in general about people's personalities. Then what he does have is a moderate to high composure and a relatively high market engagement. This basically means...
One would hope.
Yeah, one would hope. What this means, though, is how would this impact how we're going to invest for Roland? It's all very nice to pay lip service to this, but we actually have to use this to develop a portfolio for Roland. With relatively high composure, we can look at low investments with low liquidity. We could look at private equity or unlisted property as an example. We could look at long-term investment strategies. He's likely to be comfortable with the ups and downs of the day-to-day in the market. I know from looking at Roland's assessment, he would have been extremely uncomfortable to underperform the market when the market's up.
Correct.
And he would be quite happy if the market was down as long as he's done better than the market. So those are the that's a great kind of investor to deal with. But you get a lot of investors that just want absolute returns. So this helps us identify whether the client wants an absolute return or a relative return benchmark. The market engagement is great again. Roland's got high market engagement. He's likely to trust financial markets. And it's very important, again, to understand that. His perceived financial expertise, guess what, is high. And again, the important word there is perceived. It's not whether
I'm an above average driver is what you're saying, right?
Now, what does this mean? And
he
actually,
thinks he's very smart.
now, what does this mean, actually? This means that we are likely to show Roland a number of different types of investment ideas. He's going to want to be engaged in the portfolio. He's got low delegation and low belief in skill, which, again, you want to make sure that you are constantly giving him feedback on his portfolio, because he's not going to trust you to just make financial decisions on his behalf.
You want to challenge a kind of person like me with new ideas and try and get me engaged in the process.
And he wants facts, I'm sure. Facts and figures of proof, basically. Why are you making these decisions?
Definitely. Well, if anything, he'll make up his mind very often himself. So you just will have a lot less of an active role in Roland's portfolio, but you would be constantly need to feeding him with the next best idea in the market. Where very often I find a client who's got a high delegation, high belief in skill is often the CEO of a company. They're used to making broad executive decisions. Once you've met with them, they tell you exactly what's going to happen immediately. The financial director is very often someone with low belief in skill, low delegation, and they're quite difficult clients to deal with. They don't make decisions quickly. So you need to deal with those clients in different ways.
Well, listen, I'm surprised that you've even got a line there, Roland, on belief and skill. I thought there wouldn't even be a line as far as, and at least it comes in low. Phil, did you have to put in that line?
Yeah, we had to show it somewhere. It was slightly off the page. I had to.
That's what the research is showing. It's very difficult to outperform.
Okay, so let's
the important thing though, Phil, is explain to me how any of this has really got to do with investor objectives at the end of the day. Because what you're really trying to do for a client is you're trying to match assets and liabilities, at the end of the day.
Well, first and foremost is I think everyone around the table will agree the most important component of investment management is asset allocation. So the whole debate around active versus passive is not whether active is better than passive. It's actually that asset allocation is the most important thing, and whether active management adds any value whatsoever. So the trick here is actually to convince clients to invest. You've got to remember that a private client is not an automatic investor like a pension fund. You've got to convince them that investing is a good idea to start off with, because they're currently sitting in cash. And they're not comfortable with investing, and they're in cash for a reason. So what we're going to do is use this to design a strategy that will obviously suit you. And at the end of the day, if we can get a client that's in cash into a strategy that will be tailored to their portfolio, tailored to their specific risk profile, we can add value to them immediately.
Is there physical evidence that this works, the system? Has it been working for you?
Well, what we've definitely found is that clients that have been through the process are more likely to stick with their portfolios, and that is significantly important. We find, if you look at, there's some great evidence out there showing how private clients, even in the mutual fund or the unit trust space, try to time the market and destroy returns by 3%, 4%, and 5% and more. You see it on the US data that we've seen. We've seen it in typical mutual fund data. So what we're trying to do as well is kind of protect yourself from yourself in many respects, and the way you design the strategy will differ according to individuals. So let me give you an example. Equity exposure. We want a moderate risk client to, let's just for argument's sake, say have 55% equity exposure. Now, two clients will look at it very differently. I would be telling you right now to look at European and American stocks because they are attractively valued. But you might be saying to me, are you crazy? That's where all the trouble in the world is. But how do we then get you to invest? Roland would probably say, that's great. The valuations are low. This is the time to invest.
But because of his understanding of financial markets and understanding of kind of value in the market.
Correct. Someone who has less perceived financial expertise, less composure, you would probably look to put some sort of a strategy in place where there's exposure to those markets, but with some form of protection, so that they can sleep at night, so that they're comfortable with the strategy, and they know that regardless of the way it plays out, they'll still get their money back at the end of the day. And that's very, very important, because I like to say it's important to get off the couch and to actually invest. And most clients don't get off the couch, and they don't ever actually start investing. So the value add is really getting clients to take risk in a way that they are comfortable with, because on average, investors take way too little risk. I don't think I've ever met an investor that's taking too much risk for their risk profile, particularly in the ultra high net worth space.
So how does that affect your approach to those high net individuals?
Well, when you go and meet someone and you've already seen their results to their behavioral assessment, those are the kinds of answers that would take many, many years of a relationship with that client to understand. If anything, you might never understand them because they don't always understand them about themselves. Any of you have ever done a Myers-Briggs or those psychometric assessments, you find out things about yourself that you didn't know. And that's the kind of important part of this, is you're able to drill down very, very quickly and understand what truly is behind that client. Now, that could apply from an ultra-high net worth client right the way down to a retail client. So it allows you to break through all those questions that you would normally ask that might get you to an answer over years and years. You can actually assess this very, very quickly.
So it's just basically, this is just a more sophisticated tool to start out the relationship. So Roland, do you agree with your personality test here? Are you happy with the findings?
I would think that somebody who knows me should be better at answering it than myself, because obviously you sort of have a vested interest in these kind of things. But I think broadly speaking, my wife would agree with this.
Look, I would agree with it, having known him, you know. And I'm just worried about the skill thing, because I don't even think that line exists for him on low. I think it's completely off the scale.
All it says is you want to have some kind of passive component to your investment. Right?
Look, a 95% passive component to portfolio. I'm really
and you, Quibby, where would you rate on composure?
On composure, firstly, I think Roland's score on composure, I think is perfectly right. And as a matter of fact, I think it could even potentially be higher, predominantly because he's actually seen a whole range of market crashes. He's actually modeled numbers around those. And obviously, he's a very informed investor. So he understands the kind of stuff that's going on. But that's not necessarily the case when you get to a client. A client sometimes think they know everything, and hence why a lot of online share broking systems are out there. And guys trading foreign exchange and a whole range of stuff. And people would say to you, well, I could do it myself. Yeah. How difficult can it be?
Yeah.
And that's in essence what we're sitting with here at the moment, is to actually show somebody that you can actually, you've got a profile, and how do you invest in accordance with that?
Well, my response to Roland when he sent his questions back to me, and I said to him, oh, guess what, your belief in skill is low, is he said, well, surprise, surprise. But I said, well, he said obviously would never pay for a stock picker. But I said, would you pay for someone who provides asset allocation advice? And his answer to that was yes. So importantly, again, let's define active management. If we're talking about stock picking, we know it's very hard to get right. Asset allocation is your most important decision you can make.
Well, that's where you manage risk most, rather than trying to outperform but relative to a benchmark.
100%. Investment management is about risk management.